Total assets for the hedge fund industry reached an all-time high of $2.6 trillion in 2013. Despite the recent crisis, alternative investments were able to regain its appeal thanks to the institutionalization of the industry and a very favorable market environment. With lower expectations for traditional assets, many institutional investors have increased their allocation to a more flexible alternative assets to secure both performance and diversification for their portfolios. As a result, hedge funds are now growing faster than any other type of assets. Now that they face strong regulatory constraints, institutional investors have also imposed increased transparency on the industry. And the industry has consolidated itself because not all hedge fund managers could follow. Today, most of the assets are concentrated in the 50 largest hedge funds, each with several billion dollars of assets under management. Specialists, which are smaller in size, also attract attention, however, thanks to their niche positioning. Multi-hedge funds bring a combination of expertise to meet these transparency requirements and optimize the risk-return ratio. It makes it easier to access a range of strategies adapted to volatile market contexts, which are often too complex to analyze and select directly. Another advantage is that sources of performance can be better identified with a more precise and detailed view of our positions, as well as investment and risk decisions. Over time, dynamic reallocation of portfolios across the most appropriate strategies, such as long-short equity, event-driven, or structured credit, will also provide added performance. The investor can also benefit from the ability to negotiate management fees with the selected hedge funds, throwing the pricing power that the multi-manager has. While first, hedge fund strategies address their need for more flexibility in their allocation. Second, it goes back to the point about regulation and the fact that the hedge fund industry is more mature today. A traditional hedge fund shop used to have one offshore vehicle. Nowadays, they probably have two or three. One offshore, one UCITS, addressing different investor needs with a different degree of flexibility in the way they manage the portfolio. There are different constraints in terms of management, but at the end of the day, more suitability for different types of investors. At Lyxor, we position ourselves more as a center of expertise for hedge fund investments rather than as a traditional fund of hedge fund manager as we used to be. Depending on the needs of the investors, we would aggregate all this expertise in a dedicated fund of fund format, and investors will delegate the discretionary portfolio management to us. We could also put our hedge fund selection team in touch with the investors who clearly knows where they want to go to advise them purely on manager selection. The key is to be more flexible and more pragmatic in what investors are expecting from companies like ourselves. Prior to the crisis, investors tended to see hedge funds as a homogeneous space. The old way to approach portfolio construction for institutional investors was to split these portfolios into traditional assets on the one side and alternative investments on the other, with the traditional side holding the split between equity and bonds. Since the crisis, the trend has been to construct broad portfolio in a different way across investment styles. They are now generally more knowledgeable and able to be more granular in their understanding. For instance, considering long-short equities within the equity pocket. Today, investors tend to mix all this within the same part of their broader portfolio. The search for more flexible investment solutions and new sources of return is for the long run. The industry is maturing, and there are new investment solutions, new ways to access these investment styles. So it's probably a bit new for many investors, but slowly, investors will definitely increase their allocation into alternative investments.